Everyone wants high returns, but in 2026, smart investors are focusing on something even more important: safety. With inflation, market volatility, and economic uncertainty still dominating headlines, protecting your money matters more than ever. So what's actually the safest way to invest in 2026 without missing growth opportunities? In this video, we'll break down the safest investment strategies, where experts are putting their money, and how beginners can build wealth with less risk. Today we will talk about the safest way to invest in 2026. So before we start, make sure to hit the like button and subscribe to my channel. 1. Understanding what safe investing really means in 2026. In 2026, the meaning of safe investing has changed dramatically compared to previous decades. Investors are no longer simply looking for high returns. They're looking for protection, consistency, and long-term financial security. The global economy has become more unpredictable due to inflation concerns, technological disruption, geopolitical tensions, changing interest rates, and rapid shifts in digital finance. Because of this, the safest investment strategy in 2026 is not about becoming rich overnight. Instead, it is about preserving wealth while steadily growing it over time. Safe investing means minimizing unnecessary risk, diversifying assets, protecting purchasing power from inflation, and building reliable income streams. Many beginner investors mistakenly believe that keeping money in cash is the safest option. However, inflation slowly reduces the value of idle cash every year. A truly safe investment must therefore balance stability with growth. 2. Why diversification is the strongest protection against risk. One of the safest and most powerful investment strategies in 2026 is diversification. Diversification simply means spreading money across multiple types of investments instead of putting everything into one place. The famous phrase, "Do not put all your eggs in one basket," perfectly explains this concept. Many investors lose money because they become emotionally attached to a single stock, cryptocurrency, or industry. However, no matter how promising an investment appears, every asset carries some level of risk. Diversification protects investors from catastrophic losses by balancing strong-performing assets against weaker ones. For example, if technology stocks decline during a market correction, bonds or dividend stocks may continue performing steadily. A properly diversified portfolio in 2026 often includes domestic stocks, international stocks, government bonds, corporate bonds, real estate investments, precious metals, and cash reserves. 3. Index funds and ETFs, the safest long-term wealth builders. Among all investment vehicles available in 2026, index funds and exchange-traded funds, ETFs, are considered some of the safest and most reliable choices for long-term investors. These funds allow individuals to invest in hundreds or even thousands of companies, simultaneously reducing the risk associated with individual stock picking. Instead of trying to predict which company will dominate the future, investors simply buy the broader market. Historically, major indexes such as the S&P 500 have consistently grown over long periods, despite recessions, wars, inflation, and financial crises. This historical resilience makes index investing extremely attractive for people seeking stable long-term growth. ETFs are especially popular because they offer low fees, flexibility, transparency, and instant diversification. In 2026, many investors use ETFs focused on technology, healthcare, clean energy, infrastructure, and dividend income. Passive investing has become increasingly dominant because research repeatedly shows that most actively managed funds fail to outperform the market over time. For government bonds and high-yield savings accounts for stability. When discussing safe investing, government bonds and high-yield savings accounts remain essential components of a balanced portfolio. In 2026, government bonds are considered among the safest financial instruments because they are backed by national governments, Investors essentially lend money to the government in exchange for regular interest payments and the return of principal upon maturity. While bonds generally provide lower returns than stocks, they offer stability during periods of market uncertainty. In times of recession or stock market volatility, bonds often maintain value better than equities. This makes them an important defensive asset for conservative investors and retirees. High-yield savings accounts have also become increasingly attractive due to changing interest rate environments. Unlike traditional savings accounts that pay minimal interest, high-yield accounts provide significantly better returns while maintaining liquidity and security. These accounts are ideal for emergency funds and short-term financial goals. 5. Dividend stocks and reliable passive income strategies. Dividend investing has become one of the most respected safe investment approaches in 2026. Dividend stocks are shares of companies that regularly distribute a portion of profits to shareholders. These companies are often large, financially stable businesses with long histories of consistent earnings. Sectors such as healthcare, utilities, consumer staples, banking, and telecommunications are known for reliable dividend payments. The beauty of dividend investing lies in its combination of income generation and long-term growth potential. Investors not only benefit from stock price appreciation, but also receive regular cash payments that can be reinvested for compounding returns. Compounding is one of the most powerful wealth-building mechanisms in finance because reinvested dividends generate additional future income. Over decades, this process can significantly increase portfolio value. Dividend-paying companies also tend to be more financially disciplined because they must maintain stable cash flows to continue rewarding shareholders. 6. Real estate as a safe, inflation-resistant investment. Real estate continues to be one of the safest long-term investments in 2026 because it provides both income potential and inflation protection. Unlike paper assets that can fluctuate rapidly based on market sentiment, real estate is a tangible asset with intrinsic value. Property values and rental income tend to rise over time alongside inflation, making real estate an effective hedge against rising living costs. Many investors purchase residential properties, commercial buildings, or vacation rentals to generate passive income while benefiting from property appreciation. However, direct real estate ownership requires significant capital, maintenance responsibilities, taxes, and management skills. Because of this, many investors now prefer real estate investment trusts, REITs. REITs allow individuals to invest in real estate portfolios without owning physical properties themselves. These trusts often distribute substantial dividends and provide exposure to sectors such as apartments, warehouses, healthcare facilities, and data centers. 7. The role of technology and artificial intelligence in safe investing. Technology and artificial intelligence are transforming investing in 2026, but they also introduce new opportunities and risks. Artificial intelligence is now heavily integrated into portfolio management, financial planning, fraud detection, algorithmic trading, and investment research. Robo-advisors powered by AI have become popular because they automatically create diversified portfolios based on investor goals and risk tolerance. These platforms offer low-cost investing solutions that remove emotional decision-making and simplify portfolio management for beginners. AI-driven analytics also help investors identify trends, evaluate market risks, and optimize asset allocation more efficiently than traditional methods. However, safe investing in the technology era requires caution. Many investors become trapped by hype surrounding emerging technologies, meme stocks, or speculative digital assets. The safest strategy is not blindly chasing trends, but investing in established companies with real earnings, strong cash flows, and sustainable business models. But if you like this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.